Chapter 13, Part 2, Statement of Cash Flows. We are going to prepare a statement of cash flows. I am going to demonstrate a cash flow statement preparation for you in Part 2. And then for Part 3, we'll do it again, but with a more complicated cash flow statement. What do you need in order to prepare a cash flow statement? You need a comparative balance sheet, current income statement, and additional information. So again, print out that course pack and turn to page 2 and 3 in the course pack, and you will see income statement and the balance sheet. And at the bottom of the income statement, you'll see the additional information. So the company is Joe's Repair Company, and they perform repair/consulting services. They don't sell inventory, they just sell service. They are a startup company. They started January 1st, 2000, and the statements you see are at the end of the year. We made the capital investment simple. They issued 50,000 shares of stock for $50,000 cash. They rented office space and furniture, and they performed repair/consulting services throughout the first year. Step 1 in preparing the cash flow statement. I am very orderly in how I teach cash flow, because for many years the cash flow statement was hard for me, and I broke it down into steps, and I realized it wasn't hard at all. I just needed to be more methodical in how I do it. So what statement do you find cash on? Income statement or balance sheet? And did it go up or down? Cash is found on the income statement, page 3 of your handout. So it's a startup company, so beginning of the year balance is going to be all zeros for the balance sheet. Really, this should say December 31st, 1999, but it's a startup, so they didn't have any activity in the prior year, but we just show it as zero. So for any startup company, the ending balance is going to be the same as the increase. 34 minus 0 is 34,000. So cash went up $34,000. You also have the income statement in front of you, and this is a wonderful income statement. I don't think you will see a $35,000 profit on $85,000 in service revenue for most startup companies, but it makes a good demonstration problem. By the way, that's an over 40% profit. Pretty amazing. The additional information, if you were the accountant for Joe's Repair Company, you would have to dig up that information, but we just give it to you as in a textbook problem. So the company, the first note, the company paid a $15,000 dividend. They declared it and they paid it in the current year. Again, most startup companies don't pay dividends right away. Second note, the equipment was purchased at the end of the year, so therefore no depreciation was taken. And this is just a way to make the problem a little simpler for this first round. Step 2. Now remember the order of the cash flow. It's divided up into 3 sections. The first section is operations, the second section is investing, and the third section is financing. So what you have to do, and we're going to use the indirect method, you have to analyze the income statement and some of the balance sheet changes, current assets and current liabilities, to convert net income to cash. All right, so we start, the first line on the cash flow statement is net income, and then we just start converting items that are non-cash. They have to be converted because on the income statement we use accrual accounting, and net income is calculated using accrual accounting. But that's not the way we want to do the cash flow, so we have to make the adjustments for any items that have not been collected in cash or any expenses that have not been paid in cash. So let's walk through this. You are going to look at all the current assets and all the current liabilities. So Joe's Repair Company had revenues of $85,000 in its first year. However, Joe's Repair Company only collected $55,000. How do we know this? Take a look at your balance sheet. Accounts receivable increased $30,000, and we just want to look at that increase column. We're done with the individual years. We're just going to focus on that one column that says increase or decrease, and we can see that accounts receivable went up $30,000. Well, for accrual accounting, our sales were $85,000. But for cash accounting, we can only count those sales we collected in cash. And since accounts receivable went up $30,000, we know we only collected $55,000. Therefore, we have to subtract that from net income. Now turn to page 4 and you will see the completed cash flow statement, and you will see the first section, cash flow from operations, cash flow from operating activities. The very first line there is net income, and we just pull that off of the income statement. In the column that says source document, write in IS, and that'll remind you that you got that $35,000 from the income statement. Okay, our first adjustment was for accounts receivable. We're subtracting that because we are adjusting it. We don't want to count $30,000 in sales, and so because they weren't collected. All right, let's look at we have no more current assets. What we have now is a current liability, accounts payable. And we see that accounts payable went up $4,000. You can see that net change. All right, if accounts payable increased, we are going to assume that that was a charge for operating expenses. So one of those items on the income statement included in operating expenses was charged, but we actually didn't pay it yet. However, we reported operating expenses on the income statement for the full $40,000 because we use accrual accounting. But since accounts payable increased $4,000, really only $36,000 of those expenses were paid in cash. So when accounts payable increases, we have to add that back to net income. By the way, if accounts payable decreases, that would mean we paid down our accounts payable, and we would have to subtract it. So follow along on your handout, and you see cash provided by operating activities is only $9,000 compared to net income, which was $35,000. So you just walked through the first section of the cash flow report for Joe's Repair Company. You start with net income and then you make adjustments. All right, step 3. Determine the net change provided by investing and financing. Let's do the second and third section of the cash flow statement. You've just analyzed the current assets and the current liabilities on the balance sheet. So let's go back to the long-term assets. The long-term assets are only the equipment. And then the long-term liabilities, you don't have any. So no data are given for the increases of equipment of $10,000 and common stock of $50,000, so we automatically assume that they were paid for in cash. So in the investing section of the cash flow report, we want to report that $10,000 purchase. And it was a purchase. We know that when equipment goes up, that means we bought something. So we're going to show that as a cash outflow or a negative $10,000. Now when common stock goes up, we had the additional information that I gave you at the beginning of this exercise. But we know when common stock goes up, we assume that was sold for cash. So that's cash inflow to the company. Okay, let's come back to retained earnings for just a second. Let's walk through those two transactions. Cash flow from investing, and you can see it on your handout on page 4. Cash flow from investing, we want to report negative $10,000. Now I'm not going to do a subtotal like I did for operations and say net cash provided or used by investing because it's just the same number. If you had a couple of numbers, you would add a subtotal here. So we go on to cash flow from financing, and we're not done with that yet, but we're going to show the issuance of common stock as an inflow. Okay, let's back up a slide and refer now back to your balance sheet. We have accounted for every change in that far right column except for retained earnings. Now, I had you take a few minutes in, I think, the Chapter 12 handout, or Chapter 12 reading assessment, to analyze retained earnings, but I would ask you to do it again. If retained earnings increase $20,000, That means that whatever the beginning balance was, and we know in this case it was 0, and we know the ending balance, which also happened to be 20, whatever the activity was, it added up to 20,000. Well, what increases retained earnings? What decreases retained earnings? Retained earnings is increased by 35,000. So if you were making a T account right now, you'd show the 35,000 on the credit side. But in the additional information, I told you that they paid cash dividends. They declared and paid cash dividends of 15,000, and that 15,000 would go on the debit side of the T account. So 35,000 to increase retained earnings, 15,000 to decrease retained earnings, and that would account for your $20,000 net change. Well, we've already used the 35,000 up here in cash from operations, so the only other piece we need is the payment of dividends, and that's a cash outflow. So cash came in from common stock of 50, cash went out at 15 for dividends, so the net cash provided or used by financing is 35,000. Now here's the thing about cash flow report. As you look at the cash flow report, I had you note that the 35,000, the source document, was the income statement. The 30 and 4,000, both of those came from the balance sheet, so write that down. The 10,000 net change in equipment also came from the balance sheet. The 50,000 also information came from the balance sheet, and then the dividend information did come from the additional information. However, you didn't need that information. You could have calculated it. You could have calculated the 15,000 by saying retained earnings was credited by 35,000 for income, for net income, and we know the net change is 20,000. Therefore, they must have paid dividends of 15,000. So either way, you could calculate that 15,000 or you could get it given to you in the additional information. Here's a final check on the statement of retained, on the cash flow report. And this is kind of a cool thing. If you take, at the very beginning of this problem, you calculated the net change in cash. Well, the net cash provided by operations, the net cash provided or used for investing, and the net cash provided or used by financing, 9,000, negative 10,000, positive 35,000, has to add up to 34,000. You already know the 34,000 when you start the problem. That's the first thing you do. And so when you're solving for cash flow, that becomes a good check figure for you. If you don't balance to that check figure, it can be a little frustrating. This concludes part 2. Let's go on to part 3 for our more complex cash flow problem.